It is not just buying and selling a stock. A lot of strategies are involved in it. Definition: investment management is the professional management of financial assets and securities to achieve a specific investment goals for clients, which can include individual and institutional investors. What is investment management? Investment management refers to handling of an investment portfolio or a grouping of assets. It involves buying and selling assets, developing investment strategies, creating a tax strategy, and managing asset allocation. It can also include banking, budgeting, and other financial duties. The term most often refers to the management of holdings in an investment portfolio and trading them to achieve a specific investment objective. Investment management is also known as money management, portfolio management, or wealth management. Key takeaways: investment management refers to the handling of financial assets and other investments by professionals for clients. Clients of investment managers can be individual or institutional investors. Investment management includes devising strategies and executing trades within a financial portfolio. Investment management firms handling over 25 million in assets must register with the SEC and accept fiduciary responsibility towards clients. Professional investment management aims to meet particular investment goals for the benefit of clients whose money they have the responsibility of overseeing. These clients may be individual investors or institutional investors such as pension funds, retirement plans, governments, educational institutions, and insurance companies. Investment management services include asset allocation, financial statement analysis, stock selection, monitoring of existing investments, and portfolio strategy and implementation. Investment management may also include financial planning and advising services, not only overseeing a client's portfolio but coordinating with other assets and life goals. Professional managers deal with a variety of different securities and financial assets, including bonds, equities, commodities, and real estate. The manager may also manage real assets like precious metals, commodities, and artwork. Managers can help align investment to match retirement and estate planning as well as asset distribution. According to an annual study by research and advisory firm Wills Towers Watson, the 500 largest investment managers had a combined total of $128 trillion in assets under management at the end of 2023. This represents an increase of 12.5% from previous year, which saw a decline of $18 trillion in AUM1. Running an investment management firm. Running an investment management business involves many responsibility. The firm must hire professional managers to deal with market, settle and prepare reports for clients. Other duties include conducting internal audits and researching individual assets or asset classes and industrial sectors. Aside from hiring markets and training, firms must ensure they move within legislative and regulatory constraints, examine internal systems and controls, account for cash flow, and properly record transactions and fund valuations. Generally, managers with at least $25 million in AUM or those who advise investment companies offering mutual funds must be registered investment advisor (RI). They must register with the Securities and Exchange Commission and a state security administrator and agree to accept the fiduciary duty to their clients. This means they may face criminal liability if they do not act in their client's best interest. Those with less than $25 million in assets only register in their estates. Investment managers are usually compensated via a management fee which is percentage of the value of the portfolio held for a client. Also, fees are typically on sliding scale. The more assets a client has, the lower the fee they can negotiate. The average management fee is between 0.5 to 2%. Challenges of investment management, market behavior. The revenues of investment management firms are directly linked to the market's behavior. This connection means the company's profits depend on market valuations. Major asset prices declines can lead to a drop in the firm's revenues, especially if the reduction is great compared to the ongoing and steady company cost. Clients may also impatient during hard times and bear markets, and even above average fund performance may not be able to sustain a client's portfolio. Low cost alternatives. Since the mid 2000s, the industry has also faced challenges from two other sources, both of which change over lower fees and human fund managers. The growth of robo advisors, digital platforms, and that provide automated algorithm driven investment strategies and asset allocation. Robo advisors do not use human beings at all other than the programmer writing the algorithm. The availability of exchange traded funds whose portfolios mirror that of a benchmark index. This exemplifies passive management since few investment decisions have to be made by human fund managers. According to some surveys, these low cost alternatives will often outperform actively managed funds either outright or in terms of overall return, primarily due to them not having heavy fees dragging them down. The pressure from the competition is why investment management firms must hire talented, intelligent professionals. Though some clients look at the performance of individual investment managers, others check out the overall performance of the firm. One key sign of investment management company's ability is not just how much money their clients make in good times, but how little do they lose in the bad. Advantages and disadvantages of investment management. Advantages: professional analysis. You can rely on the strength, history, and expertise of the investment management firm to guide your investment decisions and manage your portfolio. Full time diligence. It is common for investment managers to promise full time diligence by mitigating risk, making sure that client portfolios align with their goals, and explaining the value risk of different investments. Ability to time or outperform the market. Investment managers use different tools to align their decisions to time or outperform the market, including company fundamentals, economic indicators, and market research. Ability to protect portfolio in downtimes. Investment management have a facility fiduciary duty to act in their clients' best interest so that they rest easy their portfolios with safe even during times of distress. They may do this by diversifying asset classes and investment types, rebalancing portfolios, and hedging strategies. Disadvantages: sizable fees. The cost of using investment management can be high, so much 2% of the total client's management assets, which can cut into their client's return. Portfolio fluctuate with the market. Using an investment management firm, no matter how successful, does not guarantee results. Rather, challenges from passive managed vehicles and robo-advisors. Investment management firms may rethink their fees and minimum asset requirements to compete with new entrants in the market, including the passive management vehicles and robo-advisors. Competitors like these make investing easier. Individuals who want a no nonsense automated investing approach while paying low fees. Professional analysis, full time diligence, ability to time or outperform the market, ability to protect portfolio in downtimes, Sizable fees profits fluctuate with the market challenges from passively managed vehicles and robo advisors. Investment management firms. The five leading asset management firms and value of the assets they hold are BlackRock, Vanguard Group, Fidelity Investments, Street Global, JP Morgan Chase. These firms control 24% of the total of assets under management held by the top 500 firms. The current state of investment. The investment management industry is facing challenges, changing client expectations, and evolving technology that will continue to be huge factors throughout 2025 and beyond. Big data and artificial intelligence will also continue to be drivers of innovation in investment management, helping to increase the effectiveness of strategies like a smart beta. Here are some of the key findings from Duolite Investment Management Outlook. Duolite 2005-2025 Investment Management Outlook. Low expense ratios are likely to become more commonplace as investors seek low cost funds. Firms may have to expand the nature of their investment products to include alternative investment. AI is disrupting the industry, which means that firms must adjust, rethink how they use technology. Some of the risks and investment management firms face, including technology, cybersecurity, and regulatory developments. Investment management process. Investment managers typically design a portfolio with the client's interest in mind. This can include meeting with the clients to discuss their investment goal and risk tolerance. Based on the client's feedback, the investment management then buys the assets securities to fill the client's portfolio. From then on, managers will occasionally rebalance the portfolio as the market changes. The frequency depends on their agreement with the client. In some cases, it may be assessed once a year, once a quarter, or even every month. The more actively a portfolio is being managed, the higher the management fee. Investment managers may also provide advice to their clients in other areas such as how to save for college or retirement. Investment management is the professional management of various securities such as stocks and bonds to meet a specified investment goals for the benefits of investors. Services can be provided by individual portfolio managers, investment management firms, or financial institutions. Investment managers conduct in-depth research and analysis of financial instruments and market trends to make informed investment decisions. They develop and implement investment strategies, allocate assets, manage risks, and monitor the performance of their clients' portfolio. They also maintain ongoing communication with their clients to ensure that the investment objectives remain aligned with their financial goals and risk tolerance. What is quantitative investment? Quantitative investment refers to investment strategies that they rely on mathematical formulas to identify assets and high profit potential or low risk. Quantitative asset managers are likely to use computer modeling or statistical tools to identify potential investment that have been neglected by the wider market. What is the difference between wealth management and investment banking? Wealth management and investment banking are two common careers paths in the financial sector. The main difference is their clients, wealth managers help individuals, clients invest their savings, while investment bankers serve corporate clients. Investment managers charge a fee for their services. The exact fee structure depends on the manager and the client's needs. Most will charge a small percentage of the client's assets, a share of the annual gains, or an annual fee. Some managers may accept a flat fee for a one time consult. Investment management fees can be structured in several ways, including a flat fee, a fixed percentage of assets under management, performance based fees, or a combination of these. A fixed percentage fee is charged based on the total value of the client's portfolio and is typically assessed annually or quarterly. Performance based fees are tied to the investment management's ability to achieve a specific performance targets such as outperforming a benchmark index. In some cases, a hybrid fee structure combines with fixed and performance-based fees to align the interests of the investment manager and the client. The bottom line: investment management is a device that helps investors achieve their financial goals and objectives through the professional management of their securities and assets. By employing investment strategies, conducting through research and consistency monitoring market trends and portfolio performance, investment managers enable clients to optimize their investments and navigate the complexities of the financial markets. As fees and investment approaches vary, investors should carefully evaluate their options and choose an investment manager whose expertise, strategies, and fee structures align with their unique financial goals and risk tolerance. Ultimately, a well managed investment portfolio can significantly enhance an investor's long term financial security and wealth. Trade on the go anywhere, anytime. One of the world's largest crypto assets exchanges is ready for you. Enjoy competitive fees and dedicated customer support while trading securely. You also have access to Binance tools that make it easier than ever to view your trade history, manage auto investments, view price charts, and make conversions with zero fees. Make an account for free, join millions